Welcome to Forex Big Daddy, and today's video is going to be about the Forex trading. Before we start, we need to understand one thing, which is the Forex trading is a very profitable investment, but in the same time, it's a kind of risky investment. So we need to learn and understand before we start jumping into trading and making money working for us. The foreign exchange market, most often called the Forex market or the currency exchange market, and it is the most financially traded market in the world. It's about $6 trillion a day worth of transactions. This is about 10 to 15 times the stock market transactions a day. The Forex market opens 5 days a week from 5 p.m. Sunday Eastern Time to 5 p.m. Friday Eastern Time. About 75% of the transactions takes place between the major currencies, and we will talk about the major currencies later. One of the really good benefits in trading the Forex market is liquidity, which is the level of the market interest. And the higher the liquidity, the faster and the easier is to sell or buy the currencies. Think about it this way. If you are investing in real estate, so you buy a house and then you try to sell it to make a profit. Sometimes this house stays in the market for 5 to 6 months, sometimes more. And this makes it not easy to get your profit or your cash out. And in the Forex market, this is seconds we're talking about. So if you want to get your profit out, it's very, very easy. It takes a split of a second to get your money out. Trading the Forex market goes into sessions, and the first session is the Asian Pacific session, which includes New Zealand, Sydney, Australia, Tokyo, Japan, Hong Kong, and Singapore. In the middle of the Asian Pacific session starts the European London session, and in the middle of the European London session start the New York session, and in that time when these two sessions overlap is the most important time, and most of the trades happen in this time. Now we're going to talk about the mechanics of currency trading in the Forex market. And like any trading, basically you buy a product in a low price and sell it in a higher price to make a profit. For example, in the stock market, you buy like 100 shares of a company. Now you own this 100 shares and you wait till the price goes up and sell it and make a profit. So it's that easy. But in the Forex market, it's kind of different because basically it works in pairs. So when you buy the dollars, now you wait for the dollar to goes up. But the question is, goes up against what? So when you buy the dollar, it's going to go up against the Japanese yen. So that means Japanese yen goes down against the dollar. So that's how it works. So it's kind of the same idea in any kind of trading. So what you do is when you buy a product, you are selling cash. And when you are selling the product, you're buying the cash back. This pairs comes in two kinds. First, major currency pairs, and this all pairs that includes the US dollar on one side, like Euro, US dollar, Japanese yen, United Kingdom sterling, US dollar, Swiss, US dollar Canadian, Australian dollar, New Zealand dollar. The second kind of the currency pair is what they call it the major cross currency pairs. And this is the currency pair that does not include the US dollar. In this kind of cross currency pairs, the most active traded cross currency pairs is the European Switzerland, the European United Kingdom or the sterling, and the European Japanese yen, United Kingdom Japanese yen, sterling Japanese yen, Australian Japanese yen, and New Zealand Japanese yen. This pairs looks like that. The first is the base currency. The second is the counter currency. So when you place a trade, buying or selling, you buy and sell the base currency against the other currency. For example, if you place a trade buying 100,000 euros against the dollar, this means you just bought 100,000 euros, and in the same time you sold the equivalent amount in dollars. And when you sell 100,000 euros, in the same time you just bought the equivalent amount in dollars. So if you start your trade by buying, and sometimes they call it going long, you wait for the prices to go up and then close your trade by selling and make the profit. On the other hand, when you start your trading by selling, it's a little bit confusing, but I will try to explain it in a very easy way. As we said before, when you buy a currency, this means, and in the same time, you are selling the equivalent amount of the other currency. So when you start your trading by selling, this means you are buying the counter currency. And this, sometimes they call it going short. And when you start your trading by selling, you wait for the prices to go down. And when it goes down, you close your trade by buying the base currency, which means selling the counter currency that you bought before and make the profit. Now we're going to talk about leverage and margin balance. And this is very important in Forex trading. Leverage is how much money or currency you can control with the money you have deposited with the broker. For example, if you have an account with a broker, the leverage ratio is 50-1. This means that if you have $100 deposited with this broker, you can control $5,000 in the trading. The money you have deposited with the broker, they call it the margin. And all brokers require a percentage of the margin to be remained in the account at all the time. So we need to make sure to keep this money all the time above the margin ratio or the margin percentage. If this margin percentage went down below what the brokers required to have, basically they can close your position without any notice and make you lose the money. So in order to keep your position, make sure you have enough money in the margin to be above the margin percentage or the margin ratio. I know this margin ratio sounds like confusing, which it is, but I don't want you to worry about it at all, because in our Forex Big Daddy system, we have this risk management plan that it will never let you go below the margin ratio. Now we're going to talk about profit or loss. And in the Forex system, we have two kinds of profit or loss. The first is unrealized profit or loss, and the second is realized profit or loss. To explain the unrealized profit or loss, we're going to assume that we start a trade by buying the euro. So as we said before, we got to wait for the prices to go up and make a profit. So in the way the price is going up, we're going to see that we have a profit. So all this profit, they call it unrealized profit. And on the other hand, if the prices went down, we're going to see that we made a loss. But this loss, they call it unrealized loss. So as long as you did not close your trade, you're going to see unrealized profit or unrealized loss. And this profit and loss, you can see that is going to be always changing. As soon as you close your trade, your unrealized profit will be realized profit. So this is money you can take out. And your unrealized loss is going to be realized loss. This is money that you already lost. Just don't forget that the unrealized loss affects the margin balance. And as I said before, just don't worry about that because our risk management controls all that. So the first kind, which is the unrealized loss and profit, this is changeable. So in one day, you can see the unrealized loss, and the next day is going to be unrealized profit, or vice versa. So this changing in prices affect the unrealized loss and profit. But the realized loss and profit, it's already done. Basically, you closed your trade and you took your profit or loss. The unrealized profit or loss is very, very, very important in Forex Big Daddy system. Here is an example for the unrealized profit and loss. I'm going to assume that I'm in a stock market and I bought this 100 shares of this company, that each share is going to cost me $1. 100 shares times $1, so the whole thing cost me $100. Now I'm hoping for the price to go 25 cents a share so I can make a profit of $25. But I found out that the price of each share went down to 75 cents a share. So as long as I did not sell my shares, I have unrealized loss. So I waited for a couple days, and then I found out that the price went down more to 50 cents a share. So my unrealized loss now it's $50. But remember, this is not an actual loss. I did not lose the $50 because I still have the 100 shares. So I studied the market a little bit, and I found out that this price is not going to go lower than this, and it's going to bounce up. So I bought 300 more shares. Each share now cost me 50 cents. So 300 shares times 50 cents. So the whole thing is going to cost me $150. Now I have a total of 400 shares. 300 shares cost me $150, and 100 share cost me $100. So the average price per share is 62 cents and a half. Now I'm going to assume that the price for each share bounce up to 82 cents and a half. This means that I made 20 cents per share in profit. Now I'm going to close my trade and sell my shares for 82 cents and a half per share. This means that I made 20 cents per share times 400 shares. So I made $80 in profit, and this is what they call it, realized profit after I close my trade. So in the first of the trade, I wanted to make $25 as a profit, but in the end of the trade, I made 80 in profit. So that's it for this video, and don't forget to subscribe and hit this bell notification button so you can get all my new videos. And next video also is going to be about the Forex trading, and we're going to talk about calculating the profit in pips and spread, and a lot more things about the trading in the Forex market.